Hey everyone, Jules here on Dropping Jules, and today I'm so excited to have my friend Charina with us. Charina is with Engineered Tax Services, and today we're going to talk about everything on cost segregation. Yes, I can't
Nice.
even say that like 5 times fast. So I'm going to turn it over to my host, Edwin, who is going to do the intros, and then we'll get started. Welcome, Charina.
Ju-
Thank you.
Welcome.
Julie, thank you. Good evening, everybody. Charina, good morning to you. Or good
Good
morning.
morning.
Wow.
What are
Good
you
evening
smoking?
to you guys. Problem is, it's Christmas season. We're having fun. And today we're going to talk about cost segregation, which, like you, I can't say that 5 times fast enough. So it's going to be tight. It's going to be tough because we're going to talk about taxes and how some investors think they don't need it, or for some people that might think that won't be part of their plans. So we're going to take a deep dive into this topic tonight for those that truly need the understanding of what cost segregation is all about. Some people, like I said, think it's complicated. Others, they might think it's aggressive. And a lot of investors assume it doesn't even apply to them at all. So the goal tonight is simple: strip it down, explain it clearly, and talk about how cost segregation fits into real investment strategy. Not just a tax conversation, but a decision that impacts cash flow, timing, and long term planning. Our guest tonight, Charina Padilla. Charina, welcome. How are you?
Thank you for having me and for making this space and to educate our audience. I love Julie and I'm really excited to be here. And I know we only have an hour and a lot to cover. So I'll do my best to break it down as much as possible so you guys can have some impactful information that you can take action and make it happen, make it rain for you, right?
That's
We
right.
money hidden in your walls, right, of those real estate investment properties. So it's
Absolutely.
actual capital that we all have that some of us learned too late, right? So
Hmm.
we're
Yeah.
going to break it down today and look forward to answering any questions as we go through the process.
Perfect.
Awesome. Awesome. Thank you. Thank you. And again, welcome. This is a very hot topic because we're coming at the end of the year and, tax season and all that good stuff. So, real quick, how did you get into this whole cost segregation thing that you understand this so well?
Well, my career has not been linear, right? Just like nature, nothing's linear
Yeah.
in nature, right? So I started in architectural drafting and design and moved into construction management. Um, and then eventually I landed at Engineer Tax Services, working in their energy efficiency division in 2010. And then from there, I started getting to learn the actual uh, important things that we all should know about tax incentives, tax credits, and what the government rewards us for doing. There's certain activities that we get rewarded for if we focus on those items, right? So I started learning and applying it, and I've helped thousands of individuals and business owners put money back in their pockets and reinvest in their growth and have the ability to have the cash flow to continue growing their portfolios. So I love what I do and I wouldn't change it for the world. And happy to share my knowledge with others so you guys can make the best of your investments.
That's dope. That's dope. I love it. So when somebody, let's say myself, when investor, when you talk about cost segregation, what's the reaction that you usually get from somebody that's never heard of this before, or quote unquote might have heard it but just doesn't understand those two words combined together?
Usually they say what? That's the usual response. And then some other ones are like, yeah, I heard someone on TikTok talking about it or on Instagram. I really don't understand what it is. And many accountants and CPAs have the same response to this. They're like, oh no, I
Really?
just do accounting work. I do tax preparation. I have no idea how that works. Can you please enlighten me? So my role has been to be a resource to the CPA firms to make sure that they are working on a client retention, that they're bringing the best advisory services to their client and generate revenue for themselves as well. Because at the end of the day, they look like a hero to their clients. And then for those individuals that are wanting to learn more how the process works, I'm always happy to share what are those key concepts that they should keep in mind as they're looking for new investment properties.
That's dope. That's awesome. So if you had to explain cost segregation to a smart investor, how will you do it?
It's like the time and value of money. A dollar saved today is worth more when you're saving it today and repurposing than waiting 5, 10, 15, 20 years to have access to that capital, right? So what cost segregation allows you to do is to take the entire value of your asset and divide it into three different buckets. You're going to have your 5-year bucket that holds all of your personal properties, essentially separating all the interior from the exterior components of your property. And then the 15-year bucket is the one that contains all of your site improvements. Think of it as your landscape, fencing, driveways, sidewalks, anything that you have on the exterior of the property that's not structural and it's not actual land. So we're able to separate each of the components within the asset. And rather than waiting 27 and a half years for a residential rental or 39 years for a commercial property, you can actually fast track the deductions up to 30 or 40% to year one, now that we have the one big beautiful bill
Mhm.
in place, and you can take 100% bonus depreciation.
Thanks
So
to our friend, thanks to our friend for helping us get that
that's
that
one,
Yeah.
part through.
one of the
So,
good things that he's done. Yeah.
mhm.
So would that be a general idea to differentiate the different standards between depreciation and acceleration depreciation?
Correct. So there is this straight line or standard depreciation where you just take the total amount of your asset and you divide it in equal parts and you get that depreciation to take, and that's allowable every year for the lifetime of the asset.
Oh,
Or you can elect to use the accelerated depreciation, and in that case, that's where I come in. My firm is a licensed engineering firm, so we are allowed to break out all the assets, whereas a CPA firm, they're not engineers, so they can't really break out mechanical, electrical, plumbing. So we're able to do a full detail engineering study that's going to allow you to take the immediate deductions, and then taking it a step further, you're going to have that fixed asset schedule to use for repairs and maintenance projects, any improvements, and make sure that your records are accurate.
Mm. So for
okay.
so a quick question. So someone like let me for everyone in the room, whoever can participate, who's never heard of the word cost segregation? So I
Me.
just want to get a basis of where we're at.
Yeah, I was about to go there next because this is a really interesting and big topic.
So one, two, so probably the majority of us, right? So I know Serena, you have a presentation. Would it benefit if we just start from the basics and just like go like
Yeah,
what is cost segregation? So if you want
because
to
this
share,
is really deep. Because my next
it
question
is.
was going to be, given what she just told me, I was going to ask her how does the IRS, and I could be wrong about asking this, but how does the IRS even allow this, if the IRS even allows it?
They do allow it. And there is an actual audit technique guide that we follow. Uh, and it shows exactly what needs to be taken into consideration to make these or the reports audit proof, right? So there's specific items as far as like certification for the engineer that's coming out to the site to visit your property. That's one of the requirements. You need to be able to break out and reclassify all the building components to their useful life. So what that means essentially is that you are taking, let's think of a multifamily building, right? And you're actually breaking out every single component in each of the units. So let's say they have 10 units. So you're going to have uh, bathrooms, you're going to have
Right,
kitchens, you're going to
right.
have all the electrical that feeds your range, your oven, your garbage disposal, your refrigerator, your microwave. All of those items need to be broken out, quantified, right? And you want to have all the quantities and then have a replacement cost value.
Wow. Um,
So it gets very, very technical and
You're
in
gonna
nature,
lose.
right? But that's why there's people like us that we specialize in just that. And CPAs just don't have the capacity or the resources to have a full engineering team and staff, right? Only like the big four firms in the country they do, but for the most part, the average CPA is not gonna have an engineering team in-house to do this type of work.
wow.
We've been doing this for 25 years. I've been doing it for 15 myself. So there's, many, many projects, different types of buildings that we have evaluated. We've done anything and everything from a single family home, condos, all the way to football stadiums, hospitals, schools, where we apply all of these different incentives. And some of them could be stacked onto each other.
Okay, so let me just stop right here for a second because I have to agree with Julie on this. This is a very interesting and well in depth conversation. Um, I, 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 for one, can tell you, I have heard of cost segregation. I, I know the whipped cream of the cost segregation. What we just touched on in the last 15 minutes was enough to have me sit back a little bit and get with my people and be like, okay, we need to go back and study this for a hot minute because I know a lot, but not to this point. And so what did you count, Julie? About five people, or maybe half of the audience that we have here didn't even know about cost segregation.
Yeah.
And so the amount of education, Charina, you have right this very minute is isn't going to be not even remotely close enough to give everybody here. So
Yeah.
I think, and Julie, you can quote me on this one. We're going to touch as much as we can on them. I'm going to give this to you. You can run it as much as you want, Charina. And then we need to do like a part, not even two, like a part 7 and 8 on this thing because
She already knows that we have her on tab, but I just want to go back to two things. One is you guys heard that Edwin said I was right, so I just want to make sure we got that
oh my
recorded.
God.
And everyone knows that this is going to be recorded. It will be on my YouTube channel, Julie Colette. So look for it there. And two, with all the information, he's going to lose the last four here he has in his head. So,
Oh.
Tarina, without further ado, we're just going to let you go and get started. Okay. So,
There's no way in the world I could do this without her. Absolutely not.
Yeah, since we got through introductions, I'm going to get to the detailed
thank
information
you.
so you guys can
Go
have
for
a
it.
picture of what it looks like, right? So in this example, I have a $2.5 million property, right? You could think of it a $250,000 or $25 million property, whatever fits your budget for investments. So, but it's going to work the same. So on a regular acquisition, an investor goes in and buys a property for $2.5 million, tells their accountant, I bought this property. They put it on the schedule. They're able to write off $64,000 every year for the next 39 years. Sounds great, right? Oh, I get a write-off. Thank you very much, right?
Mhm.
With cost segregation, and this is breaking out the property into the three buckets that I mentioned earlier. The 5-year property gives you a $600,000 benefit. The 15-year property would have a $150,000 benefit. And then your 39 property, again, this row here shows your straight line depreciation. That one's still going to be divided over the lifetime of the property. So your benefit comes from the first two buckets. So with cost segregation, as it has been for decades, no bonus depreciation, you would get $174,000 to write off in the first year, and then it would drop down right under this number. The difference is not that much, and I'll show you on the next chart so you guys can see. The third example, it's using 60% bonus depreciation. As you guys, most of you probably don't know, but there was the Tax Cuts and Jobs Act of 2017 allowed us to take 100% bonus depreciation for any property purchased or acquired between September of 2017 and December 31st of 2022. After that, that rate started phasing out. So it went to 80% in 23, 60% in 24, and then 40% for 2025. So I'm using the 60% here just to give you a general number because some of you may have bought properties in 23, 24. So in this case, the first year benefit just with 60%, it's $546,000. So think of it, if you were to get 100% bonus depreciation, your first year write-off will be $750,000. So who wouldn't want to have a big tax write-off in the first year and then move on with your life and maybe reinvest that into your next acquisition, right? So far, so good. This graph here shows your 100 bonus depreciation of what it looks like. You get that big tax write-off in the first year, and then it drops slightly lower than the blue line, and that blue line is just a straight line depreciation. So if you look at the difference, it's not that much over time, but you get a massive tax deduction at first that allows you to increase cash flows, to plan strategically for the next acquisition, for improvements, without having to refinance your property because you actually have cash available that you're not paying taxes on, right? And then using the no bonus depreciation method, you still get quite a big lump sum at first, and then it starts slowly scaling down until it goes and meets the green line at the bottom. So over time, you're still using the same amount of money. You're just able to take that deduction up front. So if you have a profitable business, rental business, I'm assuming everyone here it's multifamily investors, residential rentals, or even if you're commercial building owners, over time you're able to redistribute those deductions to be used for your advantage. Any questions so far?
We're grasping it. We're grasping it. It's a lot to
Yeah,
take in. I think we're processing.
yeah.
All right, so that's how it starts getting interesting, right? And then you start looking at asset classes, right? So any type of building, I have different types of buildings here, whether it's an office building. Now, a lot of people are investing in like office buildings and turning them into executive office, kind of like co-working spaces. Same things happen with residential facilities, is co-living spaces, right? So all of this, what it's showing is your accelerated depreciation in orange and blue, and then what your straight line depreciation will be, depending on the asset class that you're investing in. Obviously, the ones that have the highest depreciation are going to be like car washes and gas stations. Those are usually 75% to 100% in the first year. But other than that, this is pretty standard. I would say 40%, 30 to 40% will be the average reclassification. So if you buy $1 million property, you know that you can count on a $300,000 tax deduction within the first year through the fifth year, depending on your tax filing structure, right? Because that depends on each individual. And then this last graph, again, still talking about the same, but so that you guys can see the difference. This one's showing what your first year depreciation would be if you bought a property in 23. This is prorated to the year that the month that the property was placed into service. So these was probably placed into service in November or December. And then what the first year benefit would be when you apply cost segregation. And then it resets on 9,200. And then with cost seg, you get a couple more years of high deductions, and then it resets at 7,100. So the difference is not that much, but you're getting the benefits up front. So it's a no-brainer at the end of the day.
Charina,
Can I
hi,
ask you a
this is
question?
Diana. I have a question to you. What happens if we sell the property in year 5 or year 6?
It depends on how much depreciation you've taken at that point when you sell the property. if you've taken all of it, all 15 years up front, whether or not you apply the 100% bonus, there will be something called depreciation recapture. And that's a great question because it actually flows into the next slide. But depreciation recapture is comparable to getting a job, getting hired, and they give you 5 years worth of salary in year one, and then you only work for them for 2 years. Well, guess what? You're going to have to pay for the 3 years that you didn't work for them. So that's what depreciation recapture is. But there's ways to mitigate that. So when you're getting a cost segregation study that it's engineer and detail, there's ways that you can minimize recapture, right? I don't know if you guys are familiar with 1031 exchanges, but that's one way. And the other way, it's obviously keeping track of every single item in your property that has been disposed or retired. So having a fixed asset schedule that shows all of those details, it's very easy for your CPA or accountant to be able to remove some of those items. Or we can also do a reverse cost segregation study. We call it a cell allocation study, where we go back in and reverse what was done and try to identify the items that were already retired, so your depreciation recapture is minimized. So if you've had a cost seg done in the past and you're planning on selling it, maybe it would be worth a conversation to see what are the options for you.
Thank you. Thank you very much. Very interesting.
Thank you for being here, Yana.
I love you, Shrina. I'm so happy. I'm so happy I was able to attend.
Awesome.
So I have a quick question. Hey, good evening, everybody. My name is Christian Prescott. Um, I just want to ask, like, so is this really about like tax advantages and whatnot? I was kind of late to the party. Just want to be briefed in a little bit.
Yeah, Christian, thanks for being here. Yes, this is for you to learn how to leverage the tax code for real estate investments, whether it's a residential rental or a commercial property. It's not just about the cash flow, right? You want to be able to capitalize on other incentives that the government has made available for us all, right?
And the one thing, Christian, she also does, 1031 exchanges. She helps with grants. I just dropped her one pager. So we just started with cost seg because it's end of the year and we're trying to get that. So in 2025, the new tax and code is 100% if the property was purchased after what, January 19th, is it? Or what date is it?
Yeah, you got it. January
Yeah,
9th.
Yes, fast to believe.
interesting.
But not all is lost. So if you or anyone you know have purchased a property in the past 5 years, we can still do a look back study and help them catch up on the missed depreciation on their current tax return.
Wow, that's definitely interesting.
Yeah, well,
You
I'm
said
glad.
All ears.
5 year reverse.
Reverse.
Yeah, so it will be a look back study. So if anyone has purchased or went through major renovation, more than $100,000 in renovations, at least home improvement. I have a slide on that. They inherited a property and they just, put it in their books. They're doing straight line depreciation. I can easily tell if they share their depreciation schedule, whether or not they're using the standard or the accelerated method. And obviously, if they're not using the accelerated method, they're leaving money on the table.
And what kind of documents would they have to bring to you for the look back study? Like how does that work?
The depreciation schedule and any inspection or appraisal reports that they may have. Those are optional, but we would want to model the building using the data of when it was placed into service, when it was acquired, or when it was built, and then create that baseline study from there.
Awesome. Question from Ellie. Does this apply to your own property or only an investment property?
Only investment property. Yeah, personal residences are not included. So again, the incentive is for business owners, right? You want to incentivize people that are running a business using real estate.
Great, thank you. Thank you, thank you.
Thank you. Thank you for participating.
And what does your company, can you go through like how it would work if we're interested in it? Is there a form to fill out? How do we, what does it cost and all that fun stuff?
Yeah, thank you. That's a great question. So to work with us, there's no upfront fees, right? If we're able to find any savings, then obviously we'll present a proposal for that. But the initial assessment, we'll do it as a complimentary service. We'll gather key details like the property address, when it was purchased, if there was any renovations, and the date that it was placed into service. There are persons that have um, their personal residence, right, that they've lived in for many years, and then they move out, they move to a different place, and now they turn it into a rental. So that place in service date now resets the clock because that property was not in the schedule before. So that's also another one to look out for. So if you're moving out and renting your place, it may be an opportunity for you to look into doing a cost segregation study. And then once we get those details, we'll go through our initial assessment, and then we'll provide you with the projections if there's any eligibility for that service or any of our other services. Like Julie mentioned, like we're also looking at other tax incentives, tax credits, and grants at the federal, state, and local levels. There's many municipalities that are giving incentives to real estate investors investing in multifamily and rural areas. So we're identifying all of these items for you and making it easy for your advisors and your CPAs to implement. So we'll do all the due diligence and put the complete package together. And then we'll offer a proposal if there's any benefit to you on that. And if you're ready to move forward, then that process takes about 6 weeks. So initial assessment is about 24 hours. So it's pretty easy and simple with some key details. And then the full process is 6 weeks where we'll do this in-person site visit, the engineering evaluation and modeling, cost estimating, and then the final reporting.
Charina, let me ask you something, because in the back of my mind, again, we structure this because, tax season is coming and it's the end of the year and all that good stuff, right? When people hear this type of tax strategy along the way, the first thing they start worrying about is an audit. Have you ever heard any fear within that model there?
Cost segregation, believe it or not, is one of the lower risk strategies that are there, right? We do offer full audit support because we're confident that our reports are complete and have every single item that the IRS requires. So if there's any questions, any concerns, like, that gives the client and their CPAs a peace of mind. I would say in the 15 years that I've been here, we've probably gotten like 4 IDRs, which are not like true audits. It's more like requests for information. They couldn't find something in our reports. Our reports are pretty heavy with information as far as like the details for all the building components. And I can show you a little sample of just one page of the engineering report of what it contains, and it goes on. So you're gonna get like nuts and bolts, hardware, everything that's in your building laid out in these reports, everything that qualifies in the 5-year, 15-year, their real property, and also a conditional factor that we're the only ones in the industry that does this, where we're able to move the scale up and down while still staying compliant depending on how the condition of that specific component is to give you a higher benefit. So their reports are pretty detailed. And then we include the tax schedules for the CPA to follow every year thereafter. So sometimes like what I've seen in the 15 years that I've been here is just like, hey, we can't find this. Oh, can you share the more information about the site visit? What are the accreditation for the engineer that went out to site? Just little things like that. And they get addressed within a week, and it gets put to rest from there.
So being challenged by the IRS is slim to none.
Correct. And we also do a lot of lobbying in DC. We're part of the real estate roundtable that, all the members in this roundtable group, they own about 70% of the real estate in the US. And we're also part of the 1790 coalition, which is the energy efficiency incentive for real estate developers. So we're very involved in DC. And, usually when new regulations and things come up, like we're already implementing it because we know what they're looking for.
That's interesting. That's interesting because you get a lot of people who uh small money, big money, whatever, they come and invest and they don't know cost segregation, right? And so they think, okay, I'll invest into a piece of property and I'll just write it off at the end of the year. So then with what you just said, what I think I might have just said, what's the biggest mistake that investors make today?
Yeah, I would say it's not keeping track of everything that they're doing with their asset. I have people that buy a property, they completely go in and gut it and rebuild it, and all of the components that they just demolished, that's money that they're throwing away. I think that that's the biggest mistake. You should have the study done, get an account for all the assets that are in there, whether you like them or not. Oh, it's an old kitchen or the bathrooms are pink. I don't like them. We're going to redo this whole thing. All of that has a price value to it. You want to get that cost segregation study before you start remodeling the building. And then once you do the remodel, then we take all the construction costs and also do a cost seg study on the construction of the new components. So now you're depreciating or writing off the first set of items that you're taking out and adding new items to the books. One example that I can give you that that is relatable, especially here in South Florida, people are, how insurance premiums are, people are, redoing their roofs and you have to do this or whatnot. Well, guess
Yeah.
what happens on the accounting side? The CPA doesn't know. They just get a receipt. Oh, I just got a new roof, $25,000. What do? They add it on the schedule as a new asset, right? Well, guess what? The original asset that they had, they're depreciating, they had a roof. So now you're depreciating two roofs when you only have one. How would the CPA know how much was left to depreciate on the old roof to write it off for you?
Right. That's interesting.
Yeah, because now that you said that, I got this really interesting question. This is more like I want to be nosy about this. What's the most expensive mistake you've ever seen?
I mean, I've seen really big mistakes.
I mean, hit me. What's the most expensive one you've ever seen? I'm curious now that that we're learning this because you don't. If anybody knows how to write these things on the schedule, you don't write two roofs over one head. Like
But they
you,
do.
you,
It's very common. And the IRS says you must maintain accurate records. But how are you going to maintain accurate records if you don't know what you have?
Right.
You just have everything grouped together in one lump sum.
and so that's why I'm curious. If people can make a simple mistake like that, what's the most expensive mistake you've seen so far?
I mean, it already speaks for itself, So
It's classified, okay? She's gonna have
no,
to.
it's not
I'm
classified, but
just kidding. I'm just
there's
kidding.
millions and millions of dollars.
Yes.
Like we just got our numbers for what we did this year, and we completed about 6,600 projects,
Wow.
and the total tax savings was 28 billion. And
Oh,
the team compared it to the GDP of Iceland. The GDP of Iceland is not even $28 billion. It's right
wow.
under that.
Yeah.
That's how much tax savings we're putting back into our clients' pockets just because they're being proactive and they're asking the right questions. But then again, it's like, how do we get the word out so more people know that this is doable? Anyone can do this with one property, with 100 doors, whatever you have. Like you should be looking out for yourself, right? And that's the unfortunate part with the accounting industry. Like the medical industry has advanced over the years, Back in the day, you only had one doctor that cured every single illness in the
Right.
town, right? And then it evolved, and now you have cardiologists, and you have uh, pediatrics, you have ENT, you have all kinds of specialties. But for accounting, it's the same guy.
Hmm. That's interesting.
So yeah, so then if I'm a buyer, if I'm buying the house, let's just say I'm for everybody here that doesn't understand this, if I'm buying the house, what questions do you wish investors would be asking at this point? I mean, let's say I know nothing about anything. I'm buying my first home right down the block, and I need to get into this technique of segregation. What do you think I should be asking at this point?
Um, Well, I would say focus on the items that don't have accelerated depreciation, like the actual HVAC unit and the roof, because then from there you can plan. If you know that you're going to have to replace those two items in the next few years, you know you're going to be able to write them off as well, right? Whatever's
Right.
left for the depreciation before you put the new asset on. Um, you need to be talking to your CPA to make sure that you are put into a tax efficient structure for you, because not all structures are the same for each person. Each person has unique circumstances and they have unique goals, right? So it's not about the implementation of the strategy, it starts with the design.
Hmm.
So you want to be able to design what you desire, right? And these are the goals that I want to accomplish. And then from there, timing comes into play, right? Tax season's coming. Yes, the study doesn't need to be done before the end of the year, but you would want to know what your rough numbers are for tax planning purposes. Because if you know that you're going to get an $80,000 tax write-off, you're probably not going to make your estimated payments, right? So that's money in your pocket. So if you have a tax bill, you know you're going to write the IRS a check, you want to figure out a way, what can you do with that money? Because once you send it to the IRS, it's gone forever, right? So it's
Yes.
like, what can I do with the tax money to reinvest it in my growth, whether it's my portfolio, my future, my retirement, maybe donate it to a nonprofit because they need it.
Hmm.
We always talk about this, Julie and I, it's like there's veterans out there that are,
Hmm.
there's a housing problem,
Yeah,
right? So the minute you give it to the IRS, it's gone.
it's
So
going.
figure out a way what you could do with your money that's going to benefit you, your community, your family, your future, right?
Hmm.
And then pay the tax bill with whatever's left over.
I love that.
We're not saying don't pay taxes, right? Just, you don't have to leave a tip.
I like that. Yeah.
No, that's the
And
best way to
depending
say it.
on the bracket, a very hefty tip. Two quick questions from the chat. One, can you do this nationwide or is it like state by state?
It's nationwide. We could do it in all 50 states and US territories.
Okay, amazing. And then the other one is, so if you don't need that much of a write-off, can you space it out or is it best to just get the accelerated?
Yeah, so talking about tax structures, depending on how you're classified, whether you're an active investor or a passive investor, there's different ways. So the benefits do not expire. So if you can't use them all in the first year, you could potentially eliminate your taxes for the next 3 to 5 years. And again, that gives you power to plan, right? And figure out how that fits into your design, right? So you want to um plan around that. Well, I have this tax write-off, it's related to real estate. Maybe I'll do a couple fix and flips, and I know that the gains are not going to be taxed because now I have all of these paper losses recorded into my schedule.
Okay.
Ben has a question. Of course you can, Ben. Also for commercial, is it
Can
also for commercial?
Yes, commercial and residential rentals.
Okay.
okay, so can anybody hear me? Can
No,
everybody hear me?
No, we
no,
can't.
Ben.
Hi, Ben.
Nope.
We can hear you.
Okay. So basically, I'm I'm asking because it's like it depends on what type of property and what's the size of the property, or it doesn't matter, or I mean, it depends because once you actually accelerate depreciation, if you wanna, let's say if you have an exit, the exit strategy, let's say you buy a multifamily, you want to hold it for 5 years, you depreciate, you depreciate it like mostly, and then you come to sell, then you're being hit by the then you're being hit by the depreciation. It's called depreciation recapture. Like whatever you depreciated get taxed on regular, like on a regular rate, and then you can eat shit basically when you come to
Yes,
sell because
clearly.
you have to pay. But if you do a 1031 exchange, then okay, fine, you don't pay on the profit. But if you come to sell and exit, and that also depends on your payment to the investors, that's important. So it can actually hit you sometimes also.
Yeah, so the idea here is that you want to plan your exit accordingly, and it needs to be a strategic plan. So, if you're planning on selling the property or only holding it for 5 years, make sure you're talking to your advisors, make sure you're talking to your CPA to make sure that they put the right structure in place for you, right? We're here just sharing this information as educational purposes. We're not really giving you tax advice, but it's important for you to know that if you do plan, and many investors have used this strategy for many years, even when they hold the property for 2 years or 3 years, they
Yeah.
take the write-offs because they know they have the profits to be able to utilize that and then fund their next investment. There's strategies like a 1031 exchange where you can sell one property and buy another one to replace that. It has to be a like kind exchange. And there's some
Yeah.
timing requirements that you'll have to meet, right?
Yeah, they're very strict. I mean, I'm an accountant, by the way, so that to anybody that doesn't know. So, I mean,
Yeah.
I'm coming from that background of CPA firms, and I worked also with real estate investors. So I
That's
am
great,
very
Ben.
familiar. Yeah, I'm very familiar with what you're saying. And that's it. I mean, I was just curious because I'm looking into this. I need to talk to you after, but I'm
Yeah.
looking into this cost segregation. And I'm sorry that I came late. I was stuck in my job, so it's like I couldn't join earlier. Um,
It
Sorry
will
about
be,
that.
it's recorded. It's okay, Ben. It's recorded, so it'll be on my YouTube channel. So you can check out the full recording there.
Yeah. And it's
Charina,
I'd be honored to set up a separate call with you. You can connect with me through Julie, or I guess Julie, you're posting like your
I'm dropping
link
the
there.
connect.
Yeah.
Yeah, it's in the chat.
So they can schedule a call with us, and we'll walk them through the process. But essentially, Ben, um, your situation with yourself, your investments, your clients, um, we need to look at it in a case by case scenario, right? And
Yeah,
come up with
definitely.
yeah, and have the supporting evidence on how that structure is going to benefit the individual that it's getting applied for. And we're happy to collaborate and share some of the items that we've used over the years with many of our CPAs and clients. I was mentioning earlier in the call that about 80% of our work comes from CPA firms who have developed relationships and that we're constantly adding value to what they're doing with their practice. Because as you all know, there's not many people graduating from accounting school these days, and there's many CPAs that are, retiring at this point. It's kind of like
That's
part of like that silver tsunami, right? So
Mhm.
anything that we can do to be a resource and be able to elevate your practice, we're happy to do that.
okay. Yeah, that's perfect. Yeah. Yeah, because there is like a fine delicate between the cost segregation study and the thing. Yeah, I mean, yeah, it
Yeah,
basically depends on your
yeah, and
strategy. Yeah,
yeah, and with
execution.
the 1031 exchange, I know there's like timing periods, like the 45-day identification period, the
Right.
180 days to
Six
close,
months.
selecting three
Yeah.
properties. We have our own qualified intermediary and we do 1031 exchanges for free. So um the idea here is that either we plan ahead to do a 1031 or we could go the lazy 1031 route that is planning ahead that sale so you can sell the property and then buy the new one during the same tax year. And then doing the cost segregation on the new property is now going to give you the tax write-offs to cover for the recapture or capital gains that you have on the other one, but that needs to be done on the same fiscal year for the client. And then you're not deferring taxes, you're not lowering your cost basis now. You're not held to the 45 or 180-day period. It's lazy, but it gives you more room for to take your time to find the right property for you.
Yeah. That could be very intense. The 1031 exchange and the pressure that the investors are under just to find the property, and then they can get themselves into a bad deal just because sometimes.
Right. So I think it's just looking at the situation. If they can wait to sell the property in January, now they have 11 months to find the right property. They'll do a cost seg on the second property, and but we'll have to treat it on a case by case scenario to find, make sure that we're doing what's best for the client.
Yeah, and
Charina, I have a question. So basically, if, like, let's say I have a house, and if I do 1031, I will not pay any capital gains and I will not pay acceleration recapture, right?
Yeah, it is all deferred. So what the 1031 exchange does, it defers the taxes to the future.
Okay, question, like, since I met you through Nissan, how do the large multifamily investors do that? Because the average hold is 5 years, 5 to 6 to 7 years. How do they do the cost check? What's their model, and how do they benefit from it?
Well, they're increasing their net operating income, right? Because they have more cash flow. And once they
Okay,
sell the property, they're already looking for the next property. Maybe they buy a property in between.
but they cannot do 1031 because all of the investors have to agree to move to the new investment for 1031. You cannot just have 5 people who will move and then the rest of the people want to cash out, right?
Right,
So
right.
let's say they're doing just a project and nothing else. How do they benefit from it? So they pay taxes on the exit from the capital gains, having
Correct.
the
They
so
need
they're
to be prepared for that. Maybe they decide, it went very well and they decide to invest in the next project, or they decide to go on their own and start buying their own properties. But at the end of the day, any of those liquidity events need to be planned ahead of time. So if it's a 5-year hold, start thinking about, what you're going to do next, right? Just like the example that I was giving before, it's like you need to know what you're going to do with the money. You need to know what your end goal is. Because it's
okay.
so great if we're able to make money, but what are we doing to make sure that we keep it in our pockets?
Gotcha. Thank you very much. Thank you.
Yeah, you're welcome.
We have another quick question here from Jamie.
Yeah.
How much can be used against the personal income, and what's the personal income max?
Uh, that depends on your tax rate. Like this doesn't have anything to do with the personal income. It's just with the income from the
The
property.
properties. Okay.
Right. So if you're a passive investor, you're only offsetting the income from the properties. If you're an active investor, yes, it will affect your personal income. And that's just gonna depend on a whole other conversation. Like Edwin said, probably part 4 or 5, when we take a deeper dive into real estate professional status, who qualifies, what are the requirements.
Mhm.
We can talk about that on our next session because that gets a lot of people riled up.
Yeah,
There's a huge difference between a passive and an active investor.
that makes sense. Yeah, Yara? Ayara?
Yada,
Yara. Okay, yes.
yada, yada, yada.
I gotta roll that R. Okay. Yara has a question.
Hi,
My
Yada.
question is, hello, thanks for being here and educating us. I am totally ignorant about this. My question is, I bought a house subject to back in January, and the seller, it was his primary home. So he didn't get any depreciation, right? Because it was primary. How do I get the depreciation from now on?
So the property, you said you bought it in January of this year?
Yes.
Okay. What day in January?
Uh, I think it was recorded in the 25th, I believe.
25th. Okay. And was it ready to be used as a rental, or did you have to do some improvements?
No, I didn't have to do any repair or anything. The only thing I didn't rent it until April.
Okay. Yeah, if the property was ready and available for the intended use of a rental, you could place it into service at closing date. Sometimes it does take time to get the right renter in there. But how much did you pay for it, if you don't mind sharing?
It was a sub two, you know.
But what was the total price that got allocated to your transaction?
Okay, now now I don't have the answer. It was actually a bad deal that I did with a scammer.
Mm.
And I had to take over, you know, take him out of the LLC and transfer the house to my own LLC.
Mm.
The amount I put there to buy the house the year before was 80,000, but after that I had so much more expenses because he was not paying the mortgage and other expenses too.
You said 880,000?
No, sorry, $80,000.
All right, so let's see. 80.
If I can jump in real quick, I
Yeah,
think it's I think it's like the 80,000 that she paid plus plus the subject to she took over because I think it's like a loan plus the money down basically. So it's like I think that's the basic cost basis because you want to know the cost basis, correct?
right.
Okay, so that I mean, that's usually what it's supposed to be on a traditional transaction. But I think sub two I think operates the same because it just serves the debt. So it's like actually that's a question, but okay.
Yeah, but we can collaborate further, Yara, and get the documents, and then
I
I'll
need to know about the depreciation. Can I start depreciating now this year? I have
yeah,
to wait.
you
How
can
is that?
So
start
what was the loan that you took over? Let's put it that way for example purposes.
I don't have all this information right now up here in my mind.
What
I
we can
just
do,
want to
because
know
we're
about.
coming up to the top of the hour and I do have a hard stop at 8. So
Yes. Okay.
I just dropped you the information for Charina. You can book a call with her and she'll be happy to help you out.
Yeah.
Because it's going to be more in depth than we can cover in, a few minutes.
Okay.
but this is a great example. So let's just say that her cost basis is 100,000, just to round it up. So just think of like as a rule of thumb of 30%, right? So you
30%.
would get a tax write-off of $30,000.
Okay.
Yeah.
Okay. Thank you so very much.
You're welcome, Yara. I look forward to connecting with you later.
When are going to be here next time? When is that? When are you coming back?
Yeah.
We're going to schedule
Soon.
something. She
So
comes back.
yeah,
Sure.
we'll definitely have to have her back on
Oh
with all
yeah.
these
So
questions. I love her.
great to
So
know.
This is an unfortunate situation because this is a very interesting topic. And when we first started this, I had said that I wanted to stop this halfway and just hand the mic over to Charina so she can just throw us as much as she possibly can. And I still feel like a lot hasn't been covered. Not that she hasn't covered, because she covered more than enough with a lot of you guys that asked a lot of questions. Ben, Charina, Ayala, and everybody else, Julie, myself, and everybody else, Yana. And yet, it's a simple two-letter sentence that nobody seems to understand the true definition of what cost segregation is all about. And it's a topic that needs to be touched on for people who are planning on not just investing in real estate, but also scaling what you're going to do, whether it's pad split, whether it's sober home living, whether it's single family homes, multifamily homes, whatever your little heart desire, it has to be implemented, because you're not only just leaving money on the table, like Charina said, but you're losing out on what you can possibly use to further yourself in scaling your niche, right? So if there's one thing I'm going to leave you all with tonight, is buying real estate is a starting point. That's just a starting point for anybody today. But how you structure it, how you depreciate it, and how you plan on your around your taxes, get quietly and make or break your deal over time. And that's, you heard Charina how she explained it. So the cost segregation isn't magic, is a tool. And like any other tool, and it only works like when you understand how to use it, when to use it, and why it even works. So hopefully today, this conversation is just the beginning of what's going to happen the next time we bring her back up here to the stage. This is not some gimmick for you guys to tomorrow morning get up and say, "Oh my God, I'm going to use this tool," and this is just a better framework for people to start thinking the long term investor for the long term investors. Okay, so guys, thank you all for coming out tonight. Um,
I
we
just want to say
appreciate.
one thing before we wrap. So guys, I have used Trina has been helping me with grants. So as you all know, I'm doing well. For those of you who don't know, I'm focused on affordable housing for veterans, and she has been instrumental in helping me get grants for my nonprofit. So when I tell you the level of detail just in the grants, I got a headache just looking at the paperwork. So I can imagine the cost seg studies that they do. They've been in business for a while. She's very, hardworking, and as you can tell, she's just providing raw value. So give her some love, give her some hugs, and reach out to her. She will certainly put you in the right place. So, and Ben, bring your clients over, bro. Like, do them right. Like, look it up and see what's going on, and bring them there. So,
Yeah,
that,
And
Yeah,
he's
I would
very
love for you guys to comment on the video on
thank
Julie's
you.
page.
yes.
And if there's anything specific that you guys want to learn more, let us know. If you have any properties, we can run the free estimates for you. Julie's going to share the link for that. And then obviously, if you want to book calls, Julie has shared the calendar link as well. So just, continue learning, and, the sky's the limit, right?
It is. It is.
right.
So
That's
once
right.
again, thank you all so much. Like Edwin said, for coming on. We really appreciate you. Sebastian for jumping on, Christian, Joel, Yara, everyone. We appreciate you all. And thanks for coming on, Dropping Jules. We'll see you on the next one. Have a good night, everyone.
Thank you. Thank you so
Thank
very
you,
much. I
everybody.
Thank you.
appreciate
Appreciate
Thank
it.
it.
you.
Thank
Bye-bye.
you,
Good night,
Be in
Julie.
guys.
contact with you.
Thank you,
Thank you.
Charina.
Bye.
Enjoy.
Take care. God bless.
I
Bye.
feel like on Brady Bunch. All right, this was fun. Thanks, guys.
Thank you.
Thanks, love. Good to see you again.
Good to see you.
Yeah, bye.
Thank you again, Julie. You're the best.
Bye. You're welcome. I love you. We'll see you soon. Bye. Bye, Sebastian.